Parks Capital, where education plus investing equals success.
In this world, there are two types of people. Those that see this glass half empty, and those that see this glass half full. For the duration of this video, I would request you to be the latter. The ones that see the glass half full, no matter how hard it is to do so. I am your portfolio manager, Rajiv Dixit, and welcome to the Market Outlook video for the third quarter of 2022. There is no disputing the fact that we are going through a major correction in the equity markets in the United States and all around the world. The S&P 500 is down 21.1% for the year, while the Nasdaq is down 30.3%, and even bonds are no safe haven and are down about 11% for the year. There are not many places to hide. But this doesn't even begin to describe the bloodbath that has happened in the past 6 months. Names like Amazon, down 34%. JP Morgan Chase, one of the largest banks in the world, they are down 28%. Apple, one of the largest companies out there, is down 21%. Or how about Disney, one of the largest media companies, is down 38%. And of course, Bitcoin is down 59%. I think you get the picture. The indices do not begin to describe the real losses. Things are dark and ugly, there is no doubt about it. But for a minute, let's step away from the declines and focus on why this is happening. The reason is fairly simple, one that we've been talking about since June of last year. Inflation. The problem of inflation is completely out of control. The Federal Reserve, which is the only party in this country that can fix inflation, has had their strategy upside down for the whole year. In 2021, the Federal Reserve was behind the curve with raising rates and in fact were doing more damage to the problem by continuing their liquidity programs all through the year and by being in denial about the problem of inflation up until the end of last year. This caused inflation to grow to 7% last year. This year, the inflation story is a bit different. As we had laid out in our previous outlook, our concern with inflation in April was that the Federal Reserve would start to panic regarding its ability to control inflation due to high oil prices, and thus start to over-raise the interest rates and throw the economy into turmoil. Unfortunately, that scenario has played out in the past 3 months. Inflation is now at a 40-year high, and the Federal Reserve has lost control on its price mandate and the confidence of the market. There is total financial chaos currently playing out in the US financial markets because of this mismanagement. Never mind the geopolitical issues playing out in Europe due to Russia-Ukraine crisis. Well then, you ask, how can we see this glass half full? As long-term investors, we have one significant advantage over other market participants. We have the advantage of time and the affordability of being patient. To use that advantage in our favor, we need to learn to view these market corrections as opportunities for our long-term benefit. Yes, things are ugly right now. But with all this ugliness, there are windows of opportunity that we will all look back years from now and say, wow, that was a perfect time to buy those stocks. Companies like Amazon, Apple, and others will survive this storm of inflation. And there is no doubt about it that in few years, these leaders of the economy will be much higher than where they are right now. JP Morgan Chase is a bank that survived the perfect storm of 2008 financial crisis like an industry leader. Then why would one think that this temporary market volatility will reduce the value of this bank by 28%? Think about it. If you were in the middle of the 2008 financial crisis, the time when the entire financial system was at the brink of collapse, up close, things looked extremely ugly, scary, and downright frightening. But today, 14 years later, with perspective, it looks more like an opportunity to buy those beaten down names that survived the storm rather than to run from them. The only thing we have to do at this time is to weed out the noise and control our emotions, have less fear and a lot more excitement with a little bit of patience, and surely, down the road, as long-term investors, we will all be looking back at this and smiling, probably thanking the Federal Reserve for giving us this buying opportunity. So, why this time is even more of a reason to be excited? In our last Outlook, I had outlined to you that one of the steps we took in January of this year was to raise our cash position once the trend line broke down and it was clear that we are no longer moving in a sideways trend. I had also pointed out that our plan is to reinvest that cash once the current market volatility has subsided. Think about it. We are in a buying opportunity and have the ability to buy those companies that we would love to own for the long term at much lower prices. Now that is a good of a reason to be excited than any other. In addition to raising the cash in the first quarter, and frankly all through last year, we have been buying commodities in our portfolios. These commodities have worked as a hedge against this inflation. And once the inflation starts to show signs of settling, we would be reducing our position in those commodities and using that cash to buy investments that will serve us well for the long term. Again, another reason for excitement. So, when is the right time to reinvest the cash position? From a purely fundamental point of view, our view is that the darkest scenario of the inflation problem has already played out in the past quarter. We are at 40-year high in inflation, and the Federal Reserve is in panic mode. The history tells us that time and again, when the darkest scenario of the problem is upon us, we are usually closer to the bottom than not. We also know bottoms are choppy and take time to build. Thus, patience is required. But you know well that all buy-sell decisions in Parks Capital are based on long-term charts. Charts helped us decide when to raise more cash in January, and I believe the same chart will help us decide to reinvest it for our future. So, let's take a look at the charts and understand our strategy to maneuver this short-term volatility in the markets. This is a monthly chart of the small cap index. We have been looking at this one for a while. In January, this chart broke down from its sideways trend and helped us raise some cash in the portfolios in anticipation of the downward trend. Now, this chart is sitting on a support line we drew back in January. We expected the market to come down here and test the pre-pandemic highs, and it has done just that. In the short term, we are preparing ourselves for two different scenarios. Scenario one is that the market will meander here for a bit and then bounce off this line to start a new uptrend. If that happens, we will slowly start to invest the cash holdings. If, on the other hand, the market weakens here and starts to meaningfully go below this support, we will be raising more cash and patiently waiting for the volatility to settle. What is important to highlight here is that we are not trying to catch a bottom. No one can do that effectively. We are trying to identify a change in the long-term trend of the market and slowly change our allocation based on that trend. There is a big difference between the two. This is not market timing. If it was, we would be going in and out of the market completely. Instead, this is what active management looks like, where we are slowly adjusting our exposure and risk levels based on market trends. We believe this is an important distinction to understand. If you have questions regarding the differences between market timing and active management, please don't hesitate to reach out to us. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we are seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or during our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parks Capital is managed based on who you are. Thus, they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We are looking forward to talking with each of you in your quarterly meetings. Remember, education plus investing equals success.
Here at Parks Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.